Hi everyone, welcome to 2024 Paper 3. This is the last of the 3 A-level papers. I apologise in advance, it's also by far the biggest video. There's loads to go through here, so this might be one where you pause now and go and get a cup of tea or some popcorn or something, because we might be here a little while. Right, in this video, I'm not going to do as much of the kind of preamble as I have with the other papers, because by now you're on to Paper 3, you know what the deal is. Instead, I'm just going to focus on the differences. We're going to do a big bit about calculations in Paper 3 and how calculations are different in Paper 3 than they are to Papers 1 and 2. And then we're going to go through each of the pre-release bullet points. So, Paper 3 basics. The big difference between Papers 1 and 2 and Paper 3 is that instead of the 4 markers, you've got an 8 marker. Other than that, it's the same in terms of timing, 1 hour per section. The key thing to be aware of is that the 8 marker will make timing a bit tougher. It takes longer to write an 8 marker than it does to write two 4 markers. So that's one big difference that you've got to be aware of. Obviously, structurally, that means something different as well. So for the 8 marker, just as a bit of a recap, 2 peach paragraphs. The key thing here is not to go into too much detail in your howevers. You need howevers, but you don't need in-depth howevers, not in the same way you would for a 10 or 12 or 20. So the key thing is trying to get the 8 marker done quickly, because to be honest, 8, 10 and 12, that's where your timing's going to be tight. You've got to make sure you're really, really careful on those 3. 20 markers you should be pretty good at. You should be able to do those comfortably in time, but just make sure that you're aware that that 8 marker could be a little bit tricky. There is another reason why Paper 3's timing's a bit more tricky, but I'll go through that in a sec. So conclusions, just as a recap, this is really important for this. It's important for all of them, but it's especially important in this paper, because when you're talking about MOPS and you're talking about the market, you should have a bit better an idea of the market, because you know that it's going to be about the clothing market. So we're going to go through a bunch of market details about the clothing industry. So hopefully that'll help you bring in some of this MOPS stuff into your conclusions. Remember, you don't need a conclusion for the 8 marker, just for the 10, the 12, and the 20. Right. What content could come up? Well, everything. All 4 themes. By now, you should have revised all 4. You've revised themes 1 and 4 for Paper 1. You've revised themes 2 and 3 for Paper 2. Things that have come up in Papers 1 and 2 could quite conceivably come up again in Paper 3. There's not a rule where if it comes up in Paper 1 or Paper 2, it doesn't come up again. We've seen a few examples where this hasn't happened. So it's just worth bearing that in mind, that just because you've had something in one of the previous papers doesn't mean doesn't mean that's not going to come up here. The biggest clues are to look at the bullet points, and which obviously is something we're going to focus on. So anything could come up. Now, last bit of recap before we go on to the new stuff. Make sure you use the case study effectively. Obviously, this one has examples of 4 markers. It's the same example I've used. You would use your 8 marker instead. This is super important because the way they present the case study is a little bit different in papers, in Paper 3, both in a way that'll help you and in a little bit of a hindrance as well. So tips for success, we know we're doing timing, application, structure, and knowledge. Timing, as I've already talked about, is the most important one. Application, on Paper 3 I should say, application can be a little bit different on Paper 3 as well, so we'll talk about that when we get to the calculation section. Calculations in Paper 3 look a bit different to what you should expect or have seen in Papers 1 and 2. In Papers 1 and 2, you've seen 4-mark questions. There's no 4-mark questions on this paper, and so calculations will be required as part of an essay question. So what I've done is I've gone through the previous papers and I've looked at which questions have come up with some data or some calculations, and I've put them into this table. So what you can see is there's always, if it's a 20 marker, it might just be the 1. If it's not a 20 marker, you might get more than 1. Sometimes it asks for specific calculations. Other times it just gives you some data and asks you to use maybe tables or graphs in your answers. But either way, there's going to be some quantitative skill. You're going to have to use some interpretation of data. So we've seen, for example, takeovers with ratio analysis, like gross profit margin, operating profit margin, current ratio, gearing, ROAS. I'm going to cover all of those later in this video. We've seen investment appraisal data twice. I'm going to cover that again as well. We've seen moving averages with a table. We've seen a supply and demand diagram using an 8 marker. We've seen a few other questions using graphs and pie charts. We've seen market data. We've seen bar charts, line graphs, pie charts. We have seen investment data. We've seen exchange rates data. We've seen a whole range of things. One thing we haven't seen a huge amount of is decision trees or critical path. I'll come back to that one in a little bit. But the key thing is you have to be prepared that you might have to do a calculation question as like a calculation series as part of an essay. So we'll talk about what that kind of looks like. Paper 3 will likely show you more data in the extracts than what you've seen before. In the past, it might have just been in papers 1 and 2, it would have just been like a table of data for one particular question. You likely are going to get a little bit more data in paper 3. Sometimes it's just tables of data, sometimes it's specific calculations. One thing that makes this a little bit easier is paper 3 usually is clearer in saying using extract B or using extract C. So while I talked about the importance of highlighting the case study, sometimes you get this done. Sometimes they tell you a little bit about which direction to go in. And so this can quite often help. But usually if it says something along the lines of using the data in extract, whatever, that's a pretty clear sign you're going to have to do some sort of data interpretation. If it requires calculations, it might tell you which ones. So for example, investment appraisal will usually, has so far, said net present value and payback period, or maybe net present value average rate of return. Or it might just say accounting ratios, and then you've got to look at the tables to identify which ones you can work out with the information you've got. But you've got to prepare for this. All of the applications and data that you use, all the calculations you do, that will be your application, but you will have to explain the numbers. So if you get a gross profit margin of 60%, you have to be able to understand what that means so that you can use it in a sentence. You can't just, put the numbers on the piece of paper and then not bother writing. They're still essay questions. So that makes another thing a little bit trickier in terms of timing. So it's something else that's worth bearing in mind. You have to be able to do these calculations quickly. And usually the calculations are fairly straightforward. Like, they don't use really, really complicated numbers. The examples we use later on are probably going to be a bit more complicated than what you'd see in the exam. But that's because they understand you're also going to have to write an essay about it. So they don't want to overcomplicate the calculations and have you sitting there for 15 minutes doing the calculations. Right, pre-release bullet points. Now, I had some of my students say to me the other day when watching paper 2 that there was like adverts all over the place. And so I went on and had a look, and like you can set, so I put in the description, I'll put like these different sections have these different timestamps, but obviously YouTube can do chapters organically, like it does it themselves. So I said, okay, do the chapters, because I figured that might make it easier for people to find the right spots. But what I didn't realize is that it puts an ad break at the end of every single chapter, and some of the chapters were like 35 seconds long, so it felt like it was a bit of like a hammering. So what I'm going to do with this one, like as if I'm hosting like a proper podcast, I'm gonna like put them in specific breaks. So we're about maybe we're a couple of minutes in now. We're about to go into the pre-release bullet points. So I'll pause it now, put a little advert in here, and then in about 5 or 6 seconds, once you skip that, we'll keep going. I'm not going to turn the adverts off because I'm having a baby in August, and like I got to buy a pram and stuff like that. But I'm sure you'll all support me in that. But I'll see you in a second. We'll have a little break here, and then we'll carry on with the video. Right, well done if you stuck with it. Congratulations and appreciate it. Before we go any further, this is what you need to know about the pre-release. This is the big part here. The calculations is really, really important, but the pre-release is what gives you the biggest clues about what might come up. This is what you need to know. You don't need to have done any research to succeed. You could turn up having done no research on the clothing market, and you can still get an A or an A star. You will get case studies like any other A-level business paper, which is why point 1 is true, because you will get the case studies, and if you use those case studies effectively, you can get a really, really high mark. Doing some research, though, does help you, because it gives you some understanding of the market. You might even see a case study that you've already have some knowledge on. So you might like see, for example, you might research a particular business, and then that might be one of the 2 case studies. In which case, great, fantastic. You might know a little bit more. But if you didn't know any more, you'd have enough in the case study to answer the questions. So I'm not going to go too heavy on market context. I'm going to do some market context, but instead what I'm going to focus more on is the course content that I think could link to the bullet points. And then there'll be some like market context as we go through. The reason I've come up with those kind of ideas is because of this list of bullet points, which is the bullet point list that the exam board give students in about November. I typically, my students, we did a bit of a research task on this. I've stolen some of their research for this video, so shout out to them for helping with that, for presentations that they did at our school. But to be honest, after that, other than trying to throw in a few more clothing examples where I can, I've not really gone back to it because I know that I'm going to do this video. I know I'm going to talk about it then, but also I think actually to some degree it can kind of narrow you down a little bit too much. So I've gone through these bullet points. There's a section in this video for each of these bullet points. There's quite a lot in here, so this could take a bit of time. Obviously, I'll put the timestamps in the bits below, But my advice would be, you might want to break it down into 2 or 3 chunks, but my advice would be make sure you watch them all, because especially like the financial performance bit, I'm going to go through that in quite a lot of depth. Okay, so the first one, global clothing market trends, customer tastes and preferences, ethical considerations. There's a few bits to split up in here. So the first is thinking about the difference between high differentiation and low cost. So if we think about fashion, everyone knows fashion is split into low cost versus luxury. You think about, for example, low cost mass market businesses like Primark and H&M in particular. You think about high differentiation businesses like Hugo Boss, Rice, many others. There's so many luxury brands out there. And so when it comes to businesses and their strategies, although they're in the clothing market, they're not necessarily competing against all of the other clothing businesses. I don't think Primark is competing with Hugo Boss, for example. Primark is competing with H&M and Zara and businesses like that. Hugo Boss is going to be, competing against the high-end brands like themselves. So we've got to think about the reasons they make these decisions and how they help to maintain these advantages. Low-cost producers keep their costs as low as possible to keep their prices low to try and get their competitive advantage. Whereas the high differentiation, they're trying to provide something unique to try and maybe justify a higher selling price. Maybe their products cost a little bit more to make, but they make that back in terms of being able to use their brands to increase their profit margin. So branding is really, really important here. Now, if we think about this, we can also link this to 1.1.3 market positioning, because we can think about whether businesses are targeting a mass market or a niche market. And businesses might use a market map to identify gaps in markets or competition positioning. Now, market mapping, it's quite a small topic. It did come up in paper 1, so I don't necessarily think it's going to come up again, but it could be something you bring into another question if there's a question about positioning within a market or about marketing differences. Segmentation could also be linked here. So as you can see, I'm trying to link to as many different parts of the specification as possible and focus on those. I've looked at a few different ones. There's obviously more segments than this, but here's a few examples. Age. Clothing is heavily targeted towards different age groups. Businesses will have different age groups that they target. For example, ASOS will target a younger audience. Marks and Spencer's will target an older ones. So different people of different ages wear different clothes. I wear different clothes to people like yourselves, for example, because I'm 35 years old. And as much as I think I'm a cool 35-year-old, although maybe saying that probably disqualifies me from that race, I definitely don't dress the same way that 17, 18-year-olds do. Gender's another one as well. Clothing, in most cases, is designed for gender. Obviously, you do have gender-neutral clothing, but if you go into a clothing shop, that's pretty much menswear, women's wear, and children's wear. So the stores segment themselves, don't they? The websites segment themselves by splitting the products into different genders. You obviously it's more common with women's clothing than it is men's clothing, but you do have businesses that are only women's clothing. You've got businesses that are only men's clothing, far less frequently. Income's a big factor as well, because this impacts on our ability to purchase from luxury brands. For example, there's plenty of brands out there that I can't afford to buy, even if I did have paper 2 levels of advertising in this video. So income levels have a massive impact. Again, we've seen price elasticity in one of the previous papers, but we haven't seen income elasticity. And so you could think about how luxury brands have a significant impact, and income has a significant impact on someone's ability to purchase one of these brands. Interest is a big factor as well. So things like casual wear, sportswear, that is specific to certain interests. Maybe not so much anymore. I think those lines have been a bit blurred over the last few years, but sportswear, naturally, you would assume that's for people who are interested in sports. So things like that can be quite important. For obviously, you've got sports-specific and culture-specific clothing brands and clothing ranges. They might have an impact on interest, for example. But then when we think about the global clothing market trends, we need to think about location and how different standards and tastes can differ between countries. So global trends. I think if you probably lifted a bunch of students from England and put them into America, you probably wouldn't notice a huge amount of difference between the fashion senses, other than maybe some of the brands would be different. But I think people in England wear Nikes. I think people in America are wearing Nikes. People in France are wearing Nikes. I don't think there's that much. But then obviously in certain locations, it is very different. Religion has a big factor on this as well, because you obviously have religion-specific garments, but you also have different values and different belief systems in different countries, which might have an impact on clothing. We'll talk about that a little bit more in a second. So global marketing, cultural differences. I did say it was just going to be a second. You've got to consider cultural differences when you're marketing different areas. So for example, attitudes towards clothing, like more conservative dress, for example, they differ between countries. So when advertising your clothes in some countries, you might want to make sure that the people in the adverts are more conservatively dressed, more modestly dressed, whereas in other countries where dress sense is a bit more liberal, it wouldn't necessarily be that way. Weather conditions obviously play a factor as well, because the climate will determine a lot of the clothing that's available. And then think about the different marketing strategies. So polycentric, ethnocentric, and geocentric. The big luxury brands can be ethnocentric. You take like a business like Burberry, for example. Burberry's actually usually the business I use as an example of an ethnocentric company. People, no matter what country they're in, want Burberry for what Burberry is, and so they don't necessarily have to adapt their marketing to different countries. We've also got to think about global ethics as well, and so this is such a big issue. I could do an entire video on this, but I think you know what ethics are, and chances are when you study ethics, you probably talked about the clothing industry. These are the main kind of areas, or these are four of the main areas. The conflict between profit and ethics. Ethics typically costs more money, and so as a result, businesses might choose to I guess, like, sacrifice some of the ethics to try and make profit. Sometimes that's because of necessity, like survival is based around profit, and so as a result, they might not be able to afford to be as ethical as they'd like to. Some of it's based around competition. If other competitors are cheaper, then being ethical but having higher selling prices might be a pretty poor decision from a business perspective. We've also got to consider sustainability of materials. So, for example, we've got to consider whether the materials being used are recycled, whether the materials being used are sustainably sourced. For example, like cotton, for example. Child and slave labor is a big issue, especially in certain parts of the world, thinking in certain parts of Asia and Africa, and whether that's in different stages of the supply chain. That could be in the kind of raw materials gathering, the primary industry. It could be in the secondary manufacturing industry. We've seen plenty of examples of businesses with child and slave labor controversies. And then obviously fast fashion, which we'll talk a little bit more about later on. But fast fashion encourages overconsumption. And so the fact that we are over-consuming clothes potentially means that, okay, it's great for business because it means we're buying more, but it potentially means that businesses are producing and we are wasting more than we really, really need. And so the war against fast fashion. I saw a really interesting advert. I can't remember where I was watching it. I don't know if it was like a YouTube advert or an advert on TV, but there was an advert recently. It was pretty much about this. And it was like, it had a woman walking with a handbag, and then attached to that handbag were like the other 15 handbags she owned. There was a guy on a train, and he was wearing a tie to go to work, and but he wasn't just wearing one tie; he was wearing like 15 ties, and it was about kind of like, do we buy more than we need to buy? Now, I'm not saying that you should just wear the same clothes every single day. There's obviously hygiene reasons for that, but also like creativity and expressing your own kind of personality reasons for that. But it is something obviously worth thinking about. These businesses encourage us to turn over our wardrobes all the time. A really good example of positive ethics is Patagonia, so it's worth researching them in a little bit more depth. Really, they came into the news a couple of years ago because the owner decided that he was going to donate the business to a charitable trust that he set up. And the idea behind that was he'd obviously made a fair amount of money from the business, and he decided that he wanted the business to be sustainable and to invest in sustainability in the world. So really, really good example. Loads of stuff in there about Patagonia and about their ethical perspective and how much of a big part of their business that is. Now, we've also got some changes in trends. So sustainable clothing has become a little bit more popular, and this has prompted businesses to focus on more environmentally sustainable clothing. Nike, for example, they've just created a synthetic leather, and that halves the carbon footprint of a pair of Nike Air Force Ones, for example. So there's an example of a big business trying to make their products more environmentally sustainable because of the trend towards more sustainable clothing and people being more conscious of the impact that we have on the environment. We've also got the impact of social media. And social media and Instagram and the way that you can go viral, and e-commerce, which we'll talk about a bit more later, has allowed a lot more new entrants to join the market. So we've seen kind of like emergent clothing brands. Obviously, my surname's Goodrich, and I've seen Hoodrich all over the place over the last few years. But I feel like I only saw it 2 years ago, and obviously you can imagine it's quite confusing for me because it's basically my surname but one letter down on the alphabet. But like that's something that I've seen quite a lot of very recently and had never seen before, maybe 2 years ago. So social media and trends and virality of trends can allow new entrants to become like really big, prominent brands within the market. We've also got changing trends as well. So during COVID, we went away from formal wear into casual wear. And obviously now that we're a little bit more back to normal, although I did have COVID like 3 weeks ago, we've now started to see a bit more formal wear because people are going out a little bit more, want to dress a bit smarter. Also, though, just trends towards like working from home has meant that we've seen a little bit more casual wear. But even like within one of these areas, like formal wear and casual wear, fashion trends have changed loads. I've got this, it's always the example I use, but if you think about like how suits have changed in the last 20 years. So this photo on the right hand side there is the NBA draft from 2003. And they all look like they're wearing like their dad's clothes. They're really, really baggy, really big, really long jackets, quite like neutral colors, other than LeBron James, who turned up in a white suit. I mean, like Dwayne Wade looks like he's going to work in a bank. And then if you look fast forward to 20 years to 2023, the difference in terms of the fashion of the suits and the formal wear is crazy. I mean, you can imagine how people would react if your teachers turned up in some of those suits. Like that leopard print one, if I turned up to prom like that. But then to be fair, I've seen this in proms as well. I've been teaching for 11 years now, so I've been going to proms for 11 years. And you've seen the transition into more kind of adventurous, fashionable, creative clothing in formal wear. So we're seeing these examples. We're seeing these examples of trends changing over time. Right, before we get into this next one, let's take a little bit of a break. Right, forms of business in the UK clothing markets, independents and multinationals. First thing that's worth doing is just recapping briefly on the forms of business. Forms of business is mentioned, doesn't guarantee it's going to come up, but you need to know your forms of business. Sole trader partnership, private limited company, public limited company. So LTDs, now PLCs. Now, it speaks specifically about independents and multinationals, so I wonder where this might come up. But obviously, the multinationals are much more likely to be private limited or public limited companies, quite often public limited companies, whereas the independents are probably going to be maybe sole traders or private limited companies. And so making sure you know the difference of these, it could be like an example of an entrepreneur, and it could be the benefits to being a private limited company or the impact of changing to be a private limited company and things like that. So make sure you understand about risk, or the incorporated, unincorporated, unlimited liability or limited liability, and then their ability to raise finance potentially as well. But I think the most interesting so I think you need to know that. You probably need to make sure you're aware of what a franchise is as well, because although it's not super common in clothing markets, it does happen. You need I think the more interesting thing in here is about independents and multinationals. So if you go into like your local town and you look at the clothing shops around there, what you'll probably find is two types of clothing business. Independent run, one-off clothing stores, or maybe there'll be two or three, but they'll be like regional. So in Suffolk here, for example, we might have one in each of the main towns in Suffolk. But generally speaking, they're like independently run. They're not national chains. And then you've got like multinational chains with national or international brand names, the likes of like your Primarks, your H&Ms, and all of those. And so if you go into, and again, it depends on where you're going, you're probably going to see a bit of a combination of the two. And if we link this to Porter's Generic Strategies, the independents are typically going to be a little bit more high differentiation. So they're probably going to be focused differentiation because they're probably targeting a niche market. Now, there's a few reasons for that. There's a few reasons why the independents typically don't have low prices. One is because naturally multinationals can benefit from economies of scale in a much better way, and so can mass produce and therefore can sell at a lower price, whereas the independents with their smaller scale probably can't do that. That's, to be fair, that's the main reason really. It's difficult for a niche market differentiation company to have lower prices. And so typically they'll be a bit higher end. They might be like little boutiques, typically with like women's fashion. You see quite a lot of them in the areas near where I live. Multinationals though, some of them will be low cost mass market. You like, so your Primarks and your H&Ms, but others can be like, just because they're a multinational, they can still be really highly differentiated. It's just going to be based around a really high level brand. So, you think of like, so I mentioned Hugo Boss earlier, but like Gucci, there's a whole range of kind of highly differentiated businesses. So I think that's a really interesting comparison to make between the independent one-off stores and the multinational businesses that you might recognize. And the fact that the independents are mentioned, and later on in the bullet points we talk about entrepreneurs. does make you wonder whether one of the examples or one of the case studies is going to be about an entrepreneur who runs an independent clothing store. In which case, there's a few things to think about. Think about who are they targeting? Probably focus differentiation. Nice little thing to name drop potentially. But also potentially, why are they doing it? Like, what's their aim for their business? Okay, global clothing manufacturing locations. I'm obviously not going to do adverts after every single one because some of them are quite short. I'm going to try and do it like every 10-ish minutes. That's kind of like a nice natural break. Let's get straight into this one though. Global clothing manufacturing locations. Right, there's a few factors to consider here. 4.2.3, production location choices. These are some of the factors you might need to consider. Now, you can also consider market location choices. However, it does say manufacturing, so we're going to focus predominantly on the production locations. These are the kind of things you want to consider. You want to consider things like cost of production. You want to consider the access and the cost of raw materials, the access to labor, the cost of labor, the infrastructure. You might also consider geographic location. So, for example, where are they in the world? Is it easy to distribute to different countries? Or whether they're part of a trading bloc, because that might allow them to access tariff and quota-free trade. So I think the key thing here is quite a lot of the businesses will make their decisions based around if they are trying to keep their costs low, cost of production, because obviously lower cost of production and lower cost of raw materials and labor can lead to lower selling prices in a competitive market. But they'll also consider a whole bunch of things like infrastructure, for example. How easy is it to set up factories? Do they already have kind of like train lines, railway lines, roads that are going to be suitable for delivery and logistics? All of those things will be a factor. Location geographically, is it easy to get to your target markets? Is that easy in terms of quick? Is it easy in terms of efficiency of delivery? All of those things. And then trading blocks, obviously, being, for example, located in the European Union makes trades to other European Union states a little bit easier. Things like that. Now, for this next bit, I've stolen some slides that a student of mine put together because, well, first of all, I thought they were great, but it also is like much more professionally transitioned than anything I would do. So thanks to those students for lending me this. I didn't ask their permission, but they did it in my class, so I'm sure we're okay. Okay, so if you think about the map of the world here, we can point a few different areas where there's a lot of manufacturing. So we start with India. H&M, Nike, Marks & Spencer's, Tommy Hilfiger. It is the world's largest cotton producer, and they have 45 million people employed in the cloth manufacturing jobs. Bearing in mind that England's population is 68 million. That's quite like a huge workforce. And so while there are some downsides to India, their infrastructure isn't great. It's still developing. There's still quite a lot of poverty in India. It does have this absolutely massive workforce that can be accessed. The next one is to switch to Spain. So Zara, a really good example of a business famously producing in Spain. They do have higher labor costs, but production speed is much more responsive. And this is really important because if their main market is in Europe, then it makes it easier for them to respond to changes in trends in Europe and get products out to the local consumers. They changed the inventory being produced 12 times a year. In average, it's only 3 or 4 times a year in Asian production. And so they are much quicker to respond to changes and trends, and they try and get their products out much, much quicker as well. We've also got China. China heavily have invested in infrastructure for manufacturing over the last 20, 30 years, which has really put them on the map as a hub for mass production. They've got a strong business ecosystem. They've got a large pool of skilled workers. And the machinery and the equipment that they've got are at the forefront of the industry. So there's this prevailing perspective that you would only manufacture in China because it's much cheaper to manufacture in China than it is to manufacture in different places. But actually what we're finding is like the industrialization of China is meaning that rapidly incomes are rising, and so labor costs are rising. And so it isn't necessarily the cheapest option as it was maybe 10, 15 years ago. But the big benefit is what they do have is they've got this really high level of infrastructure and skilled workers who are able to produce at a really, really high level. And then if we have a look at one more example for Europe, if we look at Italy, I pick Italy as an example because Italy is one of like the fashion kind of capital countries in the world, known for its quality and craftsmanship, the innovative design and fashion expertise. You think about like Milan, for example, like the home of fashion. This can have a massive impact on the high differentiation businesses. and geographical location provides good access to ports and Central European trade. But I think that kind of like concept of made in Italy brings with it like class, doesn't it, when it comes to fashion? And so there's different locations that can be used for different reasons. But one thing you might see potentially is like I think we had it in the past when we did a different paper 3. I can't remember whether it was the gym one maybe. And we talked about the difference between like one of the questions, I think maybe the 20 marker was the difference between like Europe and Asia. And then you can talk about these things and you can talk about these comparisons in that 20 marker potentially. Okay, the impact of global clothing multinationals. All of 4.4 covers this. Now, 4.4.3, there was a bit of that did come up on an earlier paper. Nonetheless, as I've said, things can come up again. And it does say the impact of global clothing multinationals, which specifically points to this part of the course. So 4.4.1 is about the impact of multinational corporations. And then this is split into 2 categories. The impact that that has on the local economy, so creating jobs, the impact on wages, working conditions, the local community, and the impact that it has on the national economy, such as, for example, bringing in foreign direct investment, bringing in tech and skills transfers, like bringing technology and skills from more developed economies into the more developing economies. The impact that it has on culture, both positive and negative, like bringing high standards, but also potentially diminishing local cultures. And obviously tax revenue when the multinational businesses pay fair tax. So there's a whole range of factors there, both positive and negative. Global ethics we covered earlier, so I'm not going to touch on that again. And then controlling MNCs, like why? First of all, why do they need to be controlled? Well, they don't always act in the best interests of the countries that they're in, and so political influence, like sometimes it's down to politicians and political parties to try and encourage MNCs to act in a certain way, whether that's to try and encourage them to come to that country and set up bases of manufacturing. These governments can be quite competitive to try and attract manufacturing because obviously it creates jobs. Legal control, so legislations they can put in place to restrict trade from certain MNCs to try and encourage high levels of standards. Pressure groups and social media obviously have a big impact as well in trying to encourage multinational corporations to act in a certain way because of their reputation. Right, this next one's a big one, so we'll take a little break here and then we'll come back and have a look at financial performance. This is where I think the calculations might come from. Okay, there's a few things in here that I think are quite interesting. Financial performance, planning and decisions suggest 2 different things to me. So this seems like the obvious place for a calculation-based question. Financial performance suggests ratio analysis, so I'm going to go through ratio analysis. Planning could be a few things, mainly 3.3, like investment appraisal, decision trees, critical path analysis. We've seen from earlier when we looked at the different questions that had come up in previous years, we saw that investment appraisal has come up twice. We haven't seen decision trees and critical path analysis for a while, and so I'm going to go through all 3. There's no guarantee any of them come up, but I'm going to go through them anyway. With each of them, I'm going to go through it, but I'm also going to give you the opportunity to pause the video and practice the questions, practice the calculations, just so you get a bit of practice of it. So have your finger on the buzzer, ready to pause this and give these a go. Right, I have lifted this from the paper 2 video because I talked about ratio analysis there. I'm glad to say that it was useful because we got ROAS, we got operating profit margin. But that doesn't mean it's not going to come up on paper 3. And so, especially if you're assessing financial performance, well, this is the best way of doing it. So make sure you know your formulas. Make sure you know your profit margins. Make sure you know ROAS. Make sure you know capital employed because you'll need that for ROAS and for gearing. Make sure you know current ratio, asset test ratio, and gearing ratio. But most importantly, joint importance. You need to be able to do the calculations. You need to be able to interpret from the table what calculations you can do. So for example, if you don't have inventories given to you, you can't do asset test ratio. If you don't have, net profit or gross profit, you can't do gross profit or net profit margin. If you don't have the total equity and non-current liabilities, you can't do capital employed, so you can't do ROAS or gearing. So you've got to be used to being able to look at the table and figure out what information have I got, which calculations can I do. So this is the same example as in the paper 2 video. If you watched it in the paper 2 video and you did the practice calculations, then there's no need to do these again unless you want more practice. Of course, you could just change the numbers I've got and try it again anyway. But if you didn't try it, I would recommend just giving these ratios a shot, see how you get on. Okay, this is what you should have got. I'm not going to go through each of these answers, only to just explain briefly what these mean so you understand the meaning behind the numbers. So the gross profit margin of 50% means that after they've paid off their cost of sales, they still keep 50% of their revenue. So basically, suggests that they spend about 50% of their revenue on making the products. Obviously, for a clothing business, there's going to be a level of cost of sales because you have to physically make and use materials for the clothing. The operating profit margin of 17.57% means that after paying off the fixed overheads and the cost of sales, you still got 17.57% of the revenue. And then net profit is after paying off all costs and the financing costs, you still got 8.78% of the revenue. So, for example, net profit suggests that for every £1 they generate in revenue, they keep about 8.8 pence. Return on capital employed is a bit more complicated, but it's also a profitability rate measure. 13.27% means that of the money invested in the business, the capital employed, they have returned 13.27% of that as operating profit. So operating profit over capital employed. Capital employed is 240 plus 740, so that's the combination of the non-current liabilities plus the total equity, so the external plus the internal finance of 980,000. The gearing ratio assesses how much of that capital employed is coming from debt. So in this situation, it's 24.49. So that means just under 25% of the finance they've used has come from long-term loans. That's not necessarily a problem. It depends on a business's attitude towards borrowing and risk. As long as they can make the payments back, that's absolutely that would be fine. Current ratio is how many current assets they've got for every current liability. 3.4 to 1 is probably too high, really. So you'd want to be between 1.5 and 2. So they've got quite a lot of current assets for every current liability. And then asset test ratio does the same calculation but takes out stock. Now, for a clothing retailer, this is really important because asset test ratio is significant because it takes away stock because stock isn't always a reliable asset to sell. And if you think about why that would be, if you're a food brand, it would be because the products are perishable, so they could go out of date and then you can't sell them and you lose the money. If you're a technology firm, they could go obsolete or become out of date in terms of technological advancements, so you might not be able to sell them. In terms of clothing, it's about trend and fashion, isn't it? And so if your products are out of season, you potentially might not be able to sell them again until the following year, and by then, just trends might have moved on. So I think asset test ratio is quite an interesting one for a clothing business because their stock might not be a very reliable asset to sell. Obviously, some products don't have seasonality, but obviously quite a lot of clothes do. Okay, investment appraisal. This is used to determine whether a project is worthwhile on 3 criteria. Payback period, which is how long it takes to return the initial investment. We'll talk about how to do this in a second, but the calculation's on the board. So the number of years required to reach a positive cumulative cash flow, and then you work out the months by doing the amount needed to pay back, the final negative cumulative cash flow, divided by the cash flow in the following year, times by 12 to get it into months. Average rate of return. This measures how much of the initial investment cost has the business made in annual average profit. That's a percentage. The higher the better, the higher the more return. And net present value. This takes into consideration that money in the future is not worth the same as having that money now. So we'll talk about that when we have the table because it's easier to see it in the table, really. So I've got a table here with some sample cash flows. The net present value discount factors are the standard ones, so they'll be on the slide a little bit later on. But I think if you pause here and give it a try, calculating the payback period and average rate of return, and if you can remember the discount factors, doing those as well. Once you've done that, unpause and we can get on and have a look at the answers and talk through them. Okay, so our investment was 1.5 million. We're saying, let's assume this in thousands. And our cash flow in year 1 is 180. Year 2 is 330. Year 3, 320, 460, and 540. So as you can see with the cumulative cash flow, like our running total, we start at negative 1,500 and then we keep chipping away at it. But you can see that we reach the payback point somewhere in between year 4 and 5, because at the end of year 4, we're still needing 210,000. At the end of year 5, we've made 330,000 profit. And so it's clearly somewhere in there that we reach the payback period. So we've got to look at that. So we know it's between 4 and 5 years, so it's going to be 4 years and something. So what we would do is we would look at how much do we need to pay back at the end of year 4? That's still 210. How much do we make the following year? That's 540. So 210 divided by 540 times by 12 to get it into months is 4.6. So 4 years and 4.6 months. Ideally, the sooner this happens, the better, because it means we get our cash back quickly, which we can then obviously use for other business ventures. The later this pushes, the more potentially risky this is. This one actually takes quite a long time, 4.5 years in a 5-year project. It's not great, but it does pay back, which is one positive, I suppose. For average rate of return, net return is our total cumulative cash flow. So we had a £330,000 overall profit. To find the average profit, you divide that by the number of years, so divide that by 5, and then if you divide that figure by the initial investment cost and times by 100, you should get 4.4%, which means every year, on average, this business makes 4.4% of its initial investment cost as profit. The key thing is that this is as profit. So if it's a positive number, they've made a profit. Obviously, the more positive the number, the more profit they've made. So look for example, if it's like a question that asks you to compare two projects, they might give you the information for one of the projects, and you might have to calculate for the other. So thinking about the comparison could be really, really useful in terms of deciding whether this is the right proposal to go for. For the net present value, what we're effectively saying here is that 540,000 we're going to receive in 5 years, that's not worth the same as receiving 540,000 now, because 540,000 now we could use, like we could try and invest it. We could put it into a bank and get the interest and make more than 540,000. So we can't say that money we can't say 540,000 that we receive in 5 years is worth the same as having 540,000 now, because we don't have the opportunity cost to do anything with it now. So what we do is we use these discount factors to bring future cash flows in line to their current value, their net present value. So the further away we go from where we are now, which is obviously year 0, the more we discount the cash flows. And if we do the net present value for each of these years, you just do cash flow times by discount factor to get net present value. If you add them all together, in this situation, you get minus 173.96, so 173,960. That's a negative, so that suggests that when you take into consideration the fact that the money's not going to be worth as much in 5 years as it would be right now, that suggests that this wasn't the right suggestion. It wasn't the right project. We probably could have guessed this because it took most of the profit was made. Well, all the profit was made in the final year. And so that final year's profit isn't worth the same as it would be if we made that money now, because it's 5 years away. So we probably could have guessed this. So businesses might look at that and think, actually, okay, there's got to be something else we can do with our money that's going to return a better net present value. We've also got decision trees. Decision trees could be a great one for a 20 marker where you have to do a decision tree for one of the examples. So in this situation, we've got launch in the current market, which costs 6 million. We've got launch in the new market, which is 8 million. And then we've got success and failure for both of these options. So pause this here and have a go. See if you can work out the expected value and the net gain for these two options, and then I'll go through the answers. Okay, so launch in the current market, 13 times 0.8. That outcome will get you an average of 10.4. 4 times 0.2 is 0.8. So the expected value for the launch in the current market is 11.2 million. We then take the 6 million away, and our net gain is 5.2 million. So that does make a profit, which makes sense because 80% chance of getting 13 million pounds is quite significant. Launching in the new market, 18 times 0.6 is 10.8. 8 times 0.4 is 3.2. If we add those together, we get 14 million. And then if we subtract the 8 million, we get 6 million. So in this situation, obviously do nothing is going to return nothing and cost nothing. So in this situation, what we would do is we would choose to launch in the new market because that is the best option. Now, your argument against that would be, well, to be honest, there isn't one really, because even if you fail, you still make your money back. Yeah, okay, it's more likely you'll fail. 60% success instead of 80% success. But even if you fail, you still make your money back. Of course, it's all based on projection, but make sure you know how to do a decision tree just in case one comes up in that 20 marker. The last one is critical path analysis. Now, the example I'm going to show you is much more complicated than one you would get in the actual exam. The reason I do this is because if you can do this one, the ones in the exam you'll find really, really straightforward. So this is used for project planning, such as investing in a new business building or site. This could be like a new manufacturing site. And the idea is we're trying to identify how long the project will take and which activities in the project are critical to the project not being delayed and it meeting a deadline. Usually there's a deadline set. So for example, they might say that in order to meet a certain season, they might have to do it within a certain amount of weeks. So you'd be trying to work towards that. So I've just come up with like an example of a project that would involve like manufacturing or creating a manufacturing site. And you can see there's activities A through to L, and we've got different durations in weeks, so we've got different descriptions. So here is a blank critical path analysis diagram. As I mentioned already, this is more complicated than one you'd see. But using the information in the bottom, my advice would be pause this, draw it all out, and give it a try. Like, see if you can work it all out. I'll go through the steps before you do that. This is what you need to do. The first is label the durations of each activity. So the activities are the lines between the nodes, not the circles. So A, for example, is 4 weeks, B is 2 weeks, etc., etc. Then work out the earliest start time. So work from left to right. This goes in the top right quadrant and add together. And if you've got more than one option to lead into another node, you go with the highest answer. So for example, E and F both lead into 6. So you would go with the highest answer. And J and K both lead into 10. So again, with those two, you'd have 2 answers. You'd go with the highest one. The reason behind that is you can't start the next activity until both have been completed. So you need to wait for the longest duration to finish before you can move forward. Then identify the critical path. That is the path that took you from 1 to 11. So the activities on this path can't be delayed. They're critical. If they are delayed, the entire project is delayed. Then finally calculate the latest finish times, which is basically, the first thing is any nodes that are on the critical path have the same earliest start time and latest finish time. The ones we've seen in exam papers so far have been like that, so you might not have to work that out too much, but if you do need to work it out, for others you will on this one. You basically just do the latest finish time, you go from right, so with the earliest start time we went left to right, we added, and when we had more than one number we went for the biggest answer. We do the opposite for latest finish time. So we go from right to left, we subtract, and when we've got more than one option, we use the smallest answer, which will make sense when you draw it out. So pause this now, give this a try, draw it out on some paper, and then when you're ready to have a look at the answers, click resume. Okay, this is what you should have. So our critical path is A, B, C, E, H, J, L. The entire duration takes 89 weeks. Big old project there. You can see that F isn't critical because E takes 28 weeks and that takes only 8 weeks. So naturally there's a bit of a slack time there for F. And then the bottom pathway doesn't get anywhere near 86. I think it ends up at 68 weeks. So there's another bit of a delay that, like, there's another way where the bottom pathway, D, G, I, and K can afford to be delayed. So the critical path is A, B, C, E, H, J, L. The last thing you need to be able to calculate here is the float time, which is how much any activity can be delayed without delaying the entire project. Now, the activities on the critical path have float time, but the float time is 0. Okay, they have float time in that you can calculate the float time, but the float time will be 0 because if they're delayed by even 1 week, it's going to delay the entire project. Like if B, for example, gets delayed by 1 week, then the project will take 90 instead of 89. But all the ones that aren't critical, you can calculate the float time by doing latest finish time minus duration minus earliest start time. So if you're doing, for example, G, you would do the latest finish time. So you have to do that from the finish of G, which is 54. Subtract the duration, which was 4. So that gives you 50. Subtract the earliest start time of G, which will be at the start of G, which is 32, which gives us a float time of 18. What that means is G can be 18 weeks late and it will still finish in time for 89 to be the final outcome for the project. Now, what you probably notice is D, G, I, and K, they'll all have the same float time because actually it's that entire pathway at the bottom there that can be delayed by 18 weeks. If D is delayed by 10 weeks, then G, I, and K can only be delayed by 8. So it's like 18 weeks between them. Now, obviously, if they are delayed by 18 weeks exactly, between, like, collectively, they will also become critical activities because they can't be delayed without delaying the entire path. If they are delayed by 19 weeks, then they become the critical path. So hopefully that helps with some of the calculations. That's the key thing to kind of be aware of there. Right, lots of maths there. We'll take a quick break and then we'll come back and we'll get through the rest of the video. Okay, business growth and UK clothing retailers. I'm not going to do a huge amount on like examples of UK clothing retailers, mainly because I could focus on like 4 or 5 that I think might be quite significant. Look, if they come up, you're going to get a case study, and if they don't come up, I've wasted my time. And so Do you rely on the case study for the information you need about specific retailers? You probably will have heard of them anyway, if they're big businesses. And if they're not big businesses, then that's probably the independents we talked about earlier. So we do need to know the difference between organic and inorganic growth. And I will give you one example of a business that's done quite a lot of inorganic growth. So organic growth, what does this look like? Opening new branches, different areas of the country, for example, launching new product lines, maybe, for example, launching a women's wear or menswear or children's wear, expanding online. Inorganic growth looks like mergers between companies, vertical integration, for example. You might not necessarily see this in the news, but like, for example, if a retailer buys one of their suppliers, that could be vertical integration, backwards vertical integration, and takeovers. I've given an example of takeovers because there's one business over the last few years that have really made a push towards this. So Next, for example, has taken over Cath Kidston, Jules, Made.com, Fatface, and others as well. Like Next have had a really interesting one because they've also kind of gone into some partnerships with businesses. Like the Next in Martlesham, near where I live, it's a Next, but if you go in there, there's also like a Virgin Money section. There's a Waterstones, there's a Costa, like all within one Next. So it's become kind of like a store within stores. They're trying to kind of make it into like a bit of a destination. And so while they've taken over certain brands, they've also partnered up with quite a lot of other ones. So they've tried the inorganic growth in a little bit of a different way to what I've seen from maybe others. I also mentioned at the beginning that they like to show some data. And so maybe you might see some 1.1.1 market data, some like graphs showing market trends and growth in the market. But again, other than the next example, I'm not going to go through some examples of UK clothing retailers because the case study will give you that information. Entrepreneurs and UK clothing retailers. I'm not going to go through examples of entrepreneurs either because, again, I suspect it might be an independent that you've never heard of. If you get an entrepreneur, what I will do instead is just tell you what to look for within these entrepreneurs. So all of 1.5 is about entrepreneurs, focus specifically on entrepreneurial motives and entrepreneurial characteristics and what the difference between these two is. Great for an 8 marker, like assess 2 entrepreneurial motives or characteristics. Motives are reasons they've set up the business. It's like the motivational factors. So is it profit maximization? Is it profit satisfying? Is it independence and control? It could be ethical objectives, and then you've got the link between entrepreneurial motives and the ethics stuff we talked about earlier. So like global ethics, there's a lot of ethical behavior in clothing markets. There's a lot of really unethical behavior in clothing markets. Maybe there could be a link there between that and the entrepreneurial motives. So motives are like reasons they're doing something. Characteristics are the qualities they show. So risk-taking, initiative, leadership, creativity. Again, you're going to base that around the case study. So I think the main thing I can do is just say, this is the difference between a motive and a characteristic. Make sure you're aware of those and then see what the case study gives you based on that. Okay? Right, this is the last bullet point. Distribution methods used by UK clothing retailers. So the first thing you need to be aware of is the difference between direct and indirect distribution channels. Direct is where it goes produced to the consumer, and indirect is where it goes through like a third party. So for example, a producer to a retailer, and then the retailer to the customer. I think you just need to know about the difference between those two. Knowing the difference between direct and indirect distribution is really important. Obviously, typically, the big factor that changes this is you do have some clothing brands that act as both. So for example, like Nike do it both ways. Nike manufacture clothes and then have their own Nike stores, which so they're indirect in the sense that they have a retailer, but it's their own retailer. And then they also have like direct through online. So you can go on the Nike website, you can buy an item of clothing and they'll ship it to you. So the retailer doesn't exist, it's replaced by the online platform. And then they also have it where they sell their clothes and products to other businesses to be able to sell them. So like Sports Direct, for example, can sell Nike gear. So they sell it to another business and then that business sells it on. So you've just got to be aware that businesses can do more than one of these different models. It might not necessarily be that they just do one. But what we have seen is like the increased use of e-commerce and online has made it easier for businesses to be direct, where they then don't have to, give up a percentage of the profits to the other businesses that are part of the distribution channel. So let's talk about the pros and cons to online compared to in person. Pros, easy and convenient. You can grab your phone and order some clothes straight away. You can order from anywhere, anytime. I recently bought a football shirt from Italy because I've got a really like in-depth football manager save with Cremonese. the Italian second division team, and so I bought one of their shirts because I wanted to represent. I could order from Italy, despite the fact they didn't ship to the UK. I could find a website that allowed me to ship it to like this third party, and then the third party sent it to me. So you can order from anywhere, anytime, really, really conveniently. You obviously have a much bigger variety of options rather than being limited to the shops that you have close to you or within traveling distance. You can go to any store online, and there's less pressure to make purchases because you can come back to it at any time. You can go and do a bit more research. You can do price comparison, a whole range of different things. However, you do need the right technology and Wi-Fi. We obviously take it for granted in the UK, but and we're talking about the UK clothing retailers, I guess, but we also talk about the global market, and so not everyone will have access to this. It can take longer. You have to wait for delivery. That Italian football shirt took like 2.5 weeks to arrive. Like, I accepted that because I couldn't buy it closer. And I guess if you want to get something now, you can go to a shop and buy it, but it can take longer, and that is potentially a downside if you are wanting to need it for like an event that's happening that week. ASOS have had loads of problems with this because the fact that they had next day and same day delivery meant that people were just buying tons of clothes and then sending it back, and sending back half the stuff they didn't want. And so ASOS then has to, they've provided free delivery for £9.99. They've encouraged this overconsumption we talked about earlier. And then they've got to pay staff to kind of reprocess it and all of those things and quality control it before it can go back on sale. It's just caused them a huge headache. And I think, well, I know this is the fact. I spoke to someone who worked at ASOS. If ASOS could go back and undo the free delivery, unlimited free delivery for $9.99, they definitely would, because I think it's costing them too much money. And obviously, ASOS has struggled a little bit in the last few years. There's obviously shipping issues as well, for example, like damage that could happen in transit, things being delivered incorrectly, and obviously there's no way to try before you buy, which is quite important for someone wearing clothes. For example, like I'm 6'5", so if I'm buying trousers, they need to fit, like they need to be the right length. So I'm always preferring, if I can, to try items on. Of course, online does make that a little bit easier because you can send things back, but then you've got to deal with all that, and it takes even longer. So there's pros and cons. Now, what we've seen is during COVID, as you can imagine, there was a huge spike for obvious reasons in online sales. We couldn't go to physical shops. Since then, the growth rate has kind of returned to pre-COVID growth rates. So e-commerce is increasing, not just in clothing, but in all retail sales, but it's still below 30%. And so it's increasing by like 2% a year. And obviously it spiked during COVID, but now it's still increasing at like the pre-COVID level. So while COVID had a short-term massive impact, it hasn't had like a transformative impact on the market. And then finally, the last thing I wanted to mention is fast fashion, because this is really impacted by distribution. So fast fashion has been championed by businesses like Zara, more recently Shein. In the past, brands we talked about this earlier, might take 6 months to get products from design to stores. Zara's been pushing to try and get products out in weeks. And the idea is speed of delivery, speed of responsiveness to changing consumer preferences means that they can be ahead of their competitors. That can be their differentiation. It uses a lot of data, a lot of technology to try and get like data-driven decision making to try and identify trends quickly and be the first business to get that out into the market. So we've seen that fast fashion like become a real prominent source of business. That has led to the overconsumption. It's led to the ethical issues, but it is something that people and consumers really, really want. So that's it. Thank you for watching. Good luck. This is probably, given that you're about to do your third A-level paper, the last time you'll be on this channel. So thanks for all of the positive comments and the support over the last few months. Do mention to any Year 12s, that this is available. Get them using it. And I'll see them next year. And you never know, guys. Next year, when these videos, if you're subscribed, when these videos come out, you might get a little bit of nostalgia. You might decide you want to kind of recap it and live through this wonderful experience again. But yeah, good luck with your exams, and I'll see you soon.